Whoa, whoa, whoa. We have an interesting morning or start to the morning here because today I feel like we're kind of hitting the beginning of a little bit of a shifty doodle, I'd like to say, where what we noticed yesterday is people stopped caring about inflation. This was very, very weird. Usually, you only get a run like we had yesterday when inflation like the estimate was here and inflation came in low. That's usually the only time you get a run on an inflationary day. Getting a run yesterday on an inflationary day, very, very rare. And so I'm somewhat surprised by that. It's almost as if the market is saying, you know what? We don't give a hoot about your inflation or interest rates. We just going up. We are having a party and we don't care. Now, that's either a giant unsustainable bubble or the market's just changed its preference for what it wants, which could be frankly just cash flow and earnings versus caring about what interest rates are doing. So it's very, very weird. And I was reading some other folks sort of comment on this as well. And let's just put it this way: it's not normal in this environment where interest rates are 5-6% to see a bad report on CPI now and then prices up. In fact, here it is. Today's rally in stocks is on the backs of a stronger inflation print, and it marks a break from how equities have traded CPIs on days since the Fed started raising rates in 2022. The S&P, this kind of goes into some details, blah, 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 blah. Okay, so some folks think that one of the reasons for rallying on the CPI numbers yesterday was because expectations maybe were actually really worse. I don't think that's the case, mostly because expectations were put together mostly by Wall Street banks, and we ended up getting a report that was worse than what Wall Street was expecting. So I don't really personally believe that, but I do think there is this bizarre potential that basically traders or investors have decided, you know what, I'm going to invest in companies no matter whether they are basically, I'm not going to look at CPI. I'm not going to look at anything other than, are they growing and what are the cash flows? Which ultimately, that's the whole point of investing in stocks, which sort of brings up the problem child. The problem child is right here, Tesla. Tesla, which gets downgraded by Wells Fargo this morning. This is not a surprise. I think I've been complaining about the potential for Tesla getting Wall Street downgraded for about a week now. And CPI move. Let me write this down really quickly. There we go. I've been complaining about Tesla getting downgraded and Wall Street finally waking up for a while now. And a lot of people have been responding to me saying, oh, no, Kevin, Wall Street knows all. Wall Street's already pricing it in. Wall Street already knows what's going on. So it doesn't need to, basically, worry about deliveries for Q1 because it's already priced in. And I'm like, I don't think so. And so Wells Fargo came out with a nasty sort of, it almost felt like a hit, but honestly, when you read it, you kind of look at it and go, damn, well, maybe not exactly entirely wrong. But the analyst Colin Langan over at Wells Fargo basically says we're at Tesla facing headwinds from, one, disappointing deliveries, which is true, two, further price cuts, which is true. We just started seeing price cuts in China on used inventory and existing inventory. You haven't seen that before. Like, that's a new one. So you kind of see like, oh, here's our existing inventory. The price was, and then you get a price cut. I got a picture of it somewhere. Yeah, let me see if I can pull up that picture. But anyway, and Wells Fargo just slashed their price target down, to $125, a 30% decrease. It's now one of the lowest on Wall Street. They're saying the stock is way overshooting on the negative front. What is this? Dan Ives. Dan Ives gives the opposite, saying this is way overdone in the near term, that the stock is way overshooting on the negative front as the demand story is more in stabilization mode heading into the rest of 2024 and price cuts are moderating. I mean, that's an idea. That's one way to sort of respond to this suggestion that, oh, Tesla's just stabilizing. I don't know, man. I've been complaining about having negative year-over-year shipments for probably a solid week now, and I don't know that negative growth for a growth stock is what people want in a growth stock. Now, of course, there's the long-term view of, but they're making robots, the Optimus, and eventually FSD, whatever. Which I have to say, the latest I'm on I think the second version of I think I'm on the third version of FSD 12. That's gotten a lot better. But yeah, Wells Fargo, they're a little upset this morning. So yeah, they mentioned here Tesla's growth in core markets has moderated, with the EU and China flattish in the last 12 months. And the U.S. down since Q2. More concerning, the effective price cuts are moderating. Yeah. So what's really interesting is Wells Fargo actually did a very similar piece on this about a week ago. And, it was, yeah, here. Was it Goldman? Hold on, let me see. Yeah, it was Goldman. So Goldman had an interesting piece last week, and they suggested, hey, you've got to, in Tesla, be careful cutting prices so much, because if you cut prices, eventually you're going to hit this limit of elasticity of demand, basically, where just because you're doing more price cuts, you're not actually shaking new sales loose. You're just whacking margins. So I think this is very interesting. This Wells Fargo piece is, in my opinion, not necessarily wrong. And that's the scary part. It's like you want it to be. So I'm going to call, first of all, the CPI was very unusual. Let's see here. So where's today's date? CPI move. Core CPI was, where is today's date? They're 2024. They're higher. Okay. So usually, this is a little all over the place. Let's look at this together. Hold on. I want to see this together. And then we can get back to comparing the Tesla figure in just a moment. But if I go to ehack.com, I just posted the flip chart. And what we're going to do is we're going to add this up. Okay. So take a look at this. So CPI core lower. Okay, and then CPI core higher. So when it comes in lower, the S&P 500 ran higher here. Here we got a higher CPI, and the stock still went up. So we had one, I'm going to call it a core CPI lower. SPI ran anyway. Okay, how many do we have here in total? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. Okay, 24 reads. 24 reads. Out of 24 reads, when it came in higher, we had a run, so a contrarian signal. 1, 2, 3, 4, 5. Okay, so higher CPI. Okay. CPI core came in higher 5 times with with SPY running. Okay. CPI core lower. How many times did it fall when it came in higher? How many times did it fall? Well, 1, 2, 3, 4, 5, 6. That's not super useful. 6 CPI core higher, and S&P 500 falls. So, but what if you add the inlines? CPI core higher or inline and SPY falls. So let's take a look at that. If I go S&P 500 falls, inline or higher, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 times. Okay. So that's interesting. And then this kind of rally that we saw here, this was yesterday. Usually we get this surrounded by lower CPI. Do we get any lowers over here? Like CPI comes in low. Do we ever get core CPI lower, SPY falling as a contrarian, right? No, no, no. Here, one time comes in lower core CPI and SPY falls. Okay. All right. Okay. So that's interesting. So the conclusion of this chart is really generally, and this makes sense. This is logical, right? When CPI comes in lower, which it did, how many times did it? Lower or in line? I'll just say, yeah. Let's go. Let's see. Core CPI lower or in line. Stocks fell. What? I guess we'll borrow this as 1. I mean, that's, I feel like, not even really fair, but I'll count this anyway, just because they've got 1 over here. So, CPI comes in lower, and we get a fall. Actually, just one time. I mean, really just one time. I don't even want to count that. Just one time. So, CPI comes in lower. SPY falls once. CPI comes in higher. S&P 500 rises 1, 2, 3, at least 4, 5 times. So that has happened multiple times. So I don't know how useful it is. I guess it's just a way of saying over the last 24 months, this is 2 years. So in 2 years of data, it has happened before. I guess it's just weird. It seems like out of these, let's see, I'll go from here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 13 times core CPI comes in higher. Core CPI higher than expected. Of those 13 times, this will be useful for us. The stock market goes up 1, 2, 3, 4, 5. Oh, wait, sorry. No. 13 times higher than expected. Okay, because this chart's annoying. In all of these cases, it went up. CPI higher than expected. Hold on. My bad. Let me do this better. I'm only going to spend another 20 seconds on this. Sorry, I'm bugging myself. Okay, CPI higher than expected. This chart just sucks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Okay. 11 times core CPI comes in hotter. And then of the times that it comes in hotter, how many times does it go positive? 1, 2, 3, 4, 5. Yes. Okay. Yeah, that's what I thought. It's kind of like, it's almost like in that midpoint range. So 5 out of 11 times. That's 45% of the time. It's not horribly useful, I think. It just, I guess the argument is usually when you get a miss on core CPI, the stock market falls. Usually. So, what? 55% of the time? Or it doesn't move. The way I guess maybe the idea is the fact that it rallied yesterday, right? And so these high rallies here, we've had S&P 500 up 0.8. You've only had rallies on CPI above 0.5%. Above 0.5%, you've had rallies 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times. And of those, 4 times have been, so 4 out of 11 times you've had a rally over 0.5% in the SPY on CPI with hotter core CPI. So that's only 36% of the time. Okay, so it's happened before. Maybe it's not that unusual. But there is a question, and this is what I wanted to get into. The question is it possible that you have a market that says it's time to move on from just caring about what inflation does and what the Fed does? In which case, you know, you're basically excluding being interested in interest rate sensitive stocks. That's the question. And so I think a lot of folks are very optimistic about rate cuts in interest rate sensitives. But I'm also concerned that, you know, the occasional rate cuts with a hot market, unless there's some form of a correction in the economy, don't actually end up driving any kind of progress in interest rate sensitives until rates come down a lot. So I think that's where I'm trying to tie this back into Wells Fargo. I feel like that's where more and more of Wall Street is going to be concerned over that. So I think, I hate saying it, but I think this Wells Fargo report is almost the tip of the iceberg, where, you know, they're saying not only the effect of price cuts are moderating, but they expect volumes to be flat in 2024 and then down in 2025. Now, that seems very negative. They say here, in the wake of price cuts and lower lease residuals, disgruntled customers, and the possible loss of Tesla's luxury brand premium. Well, I never really saw them as a luxury, but I mean, the X and S were, that's for sure. But I will say, sentiment's pretty bad right now. And that Wells Fargo piece this morning does not help at all. So I think if we look at what the actual stock's doing, we're down like 2.5%. Yeah, we're down about 2.5% right here. So yeah, Thomas Carter, you know, you're right. You know, what the idea, it wasn't so much the idea that 75 basis points of cuts would you know, oh, that's going to skyrocket Tesla. I don't think that's the idea. The idea was that the start of rate cuts would be a tailwind, right? But the question is, who says the Fed is definitely going to keep cutting? You know, what if you end up cutting 3 or 4 times and then you just sit there? You're screwed, you know, because now you're waiting for more cuts and they don't come. So very, very interesting. The market did have a big sell-off on Monday. That is true. Easier to rebound from there. That is true. Let's see here. There was the Intel news. I did see some news about, or some Intel news about them losing a few billion bucks from, I think it was the Pentagon deal. Let me see here. Oh yeah, there it is. Pentagon scraps plan to spend $2.5 billion on Intel defense grant. Yeah, that wasn't great. At the same time, TSMC to win more than $5 billion in grants for U.S. chip plant, you know, a few days ago. So kind of crazy. Let's see here. Okay, so let's write down some of these conclusions we have here. I know that was a little bumpy to get started because that was a lot of reading there of numbers. But let's think about that. So the CPI flip was unusual, but I guess I shouldn't call it very unusual. You've got 4 out of 11 times core CPI comes in hotter. The SPY rallies. So what is that? 4 out of 11 times, you're sitting 36%. So 36%. Okay, fine. What's more is, the question then is that just a flip after the Nasdaq's Monday sell-off? Was this a Monday QQQ flip or a sign of a greater regime change? You know, I feel like I'm sounding like Ray Dalio in this regime change idea. So regime change is really, again, this idea that, you know, who really kind of set me off on this last week was Bostic. I'll write this down. Bostic last week, in case you didn't hear it, he doesn't vote. Bostic, who doesn't vote this year, which is kind of actually bad, Fed voting members. Let me look it up. Because he, I'm pretty sure, votes next year, and he's a problem. Let me see, was it? No, it was Kashkari. Was it Kashkari? I gotta figure it out. Let me see. Kashkari, Fed, pause rate cuts. Was it him? Few more months, 2 or 3 rate cuts, or was it Bostic? One of them talked about pausing. There, it was Bostic. Ah, okay, it was Bostic. Okay, so Bostic, he is a voting member. He's the Atlanta Fed member, and then next year, he's actually not a voter. Okay, interesting. But either way, this was about a week ago, and Bostic said he expects the Fed's first rate cut in the third quarter will be followed by a pause. See, this I don't think anybody really wants to hear, mostly because the idea of a lot of interest rate sensitive stocks was invest in them because we know rate cuts are coming. Once the rate cuts come, you'll have this essentially never-ending tailwind, right? So you have a never-ending tailwind on top of low comps, right? But what if that tailwind isn't actually never-ending, right? What if rates stay high until you're in a recession? Okay, well, there's some stocks that are interest rate sensitive that might actually do well in a recession. But it depends on what kind of recession, I suppose it is. But as far as expecting substantially more rate cuts outside of a recession, there's a lot of sort of countervailing talk now that, thanks in part due to AI and fiscal spending and CapEx spending by corporations really needing to allocate to artificial intelligence, you end up not needing to cut rates to keep the economy out of recession for a lot longer. So that's somewhat crazy and unexpected, but then again, a lot of people are going to say, no, we expected that. But I like this comparison right here, or not so much comparison, but this piece from Goldman was so good because, you know, they really were trying to send this signal, and this was about a week ago that we covered this, send this signal that you really have to be careful with price cuts. And if you have ever listened to the book, I think it's was Start With Why. If you've ever listened to that book or read it, boy, it's been about 10 years or whatever since I finished that book. But one of the things they talk about is how damaging price cuts are, because you basically burn your existing customer base and you piss off your existing customers and you lower the quality of the product. And so you look at the difference between an Enphase and a Tesla. They both suck right now, obviously. But the Enphase strategy is, hey, let's slow down on our output and let's preserve the brand of Enphase inverters and pricing. And their margins actually been rising. Now their volumes have been plummeting. So that's a problem. They probably do need to cut prices. But then the question is that actually going to make a difference? And so that's where I think they've made this calculus that says no, because people still have to finance batteries. Why are we going to reduce the price of the inverters if people still aren't going to finance the whole package? So I thought that was very interesting too. A lot of wildness out there. So, okay, let's see what some of y'all are saying here. Captain America shirt. You like my Captain America shirt? All right, let's see here. As sticky and resilient as inflation is at the Fed, rates should not be cut. You know, I really hate that you remind me of this, because I don't think you're wrong. There's actually there was a piece, I think it was from one of the Fed boards yesterday, and I think they talked about Atlanta's sticky inflation gauge. Let me see this. Atlanta sticky inflation Fed. And it wasn't good. So, sticky inflation is the, let's see here. Yeah, it's the pink or the orange line here. Look at this. This is Atlanta's sticky inflation chart. So basically what they've done is they've said, hey, we're going to map out how inflation is moving. So this is the Federal Reserve Bank of Atlanta. And we're specifically going to pay attention to the sticky portion. So what I can actually do is I can get rid of the flexible CPI. And this becomes a lot more apparent as a problem. See, if you leave the flexible in here, it doesn't look like that orange line is that much higher. So just get rid of this. And just what I really want you to do is compare the right side to the left side. And so what I'm saying is sticky inflation used to be 1.8, maybe to 2.5%, somewhere around here. Bob between 1.8 to 2.5%. That's sticky inflation. Well, now sticky inflation is getting stuck at 4.5%. And so these are categories that come down a lot slower. And so, of course, the concern is that this ends up hitting some kind of shelf. So we'll see. But, yeah. Well, good comment. That was a good comment. Yeah. So, and then there. It's always been a dream of mine that Kevin would post my comment stream. That's like the comments in the comment section. My greatest happiness is when people like my comment. Yeah. Maybe we'll stay at 5% forever. Well, this... Yeah, okay, so two things here. Yeah, it's possible you could stay at these levels. I mean, frankly, I don't know that if you stay at these levels for a year, it's going to make a difference. I think what happens is you could slow QT and just kind of leave rate cuts in the 4+% range. So, I'll write that down. Theoretically, you could slow rate cuts, or sorry, slow QT, or end QT, which is a form of loosening, and by doing that, you could basically put less need on lowering rates, which again hurts interest rate sensitive, rather than cutting rates. Now, as far as this question here, solar is inherently for higher income individuals, whereas cars serve a different demo. That's not great for Tesla. You know, the Tesla argument has always been, oh, they appeal to higher income demo. But I hate to say it, a lot of that higher income demo, maybe not a lot of it, but like I would say maybe half of that higher income demo is like, I wouldn't be caught dead with a Tesla because of Elon's politics. Now, you know, it's hard to measure that precisely, right? Mostly because polls are so fraught with problems, but there's a reality of that. So it's kind of been a really bad run for Tesla because you combine the Twitter acquisition which was very fraught with problems, with massive selling in Tesla stock by Elon, with higher interest rates crushing the stock, and then Elon alienating more customers, accelerating price cuts. And now you've got Robin in the board. You know, she just sold like $16 billion over the last couple weeks. I think at the end of February, she just sold a bunch. Tesla left a big hole in their growth story while Elon is busy guarding the border. This is so unfortunate. Semi not ramping, Cybertruck not ramping. Well, I do think the Cybertruck is ramping, just maybe a little slowly, and the dude is effing around. I don't know. And part of me, like, I feel so conflicted because I don't want to, you know, I think to myself, like, is it just easy to poop on Elon because the stock down, right? It's kind of like stock down, so you know, dump on Elon. But I don't know. You know, that's a risk factor. But I've been saying for a week too. I think this 150 is realistic after earnings, especially with no guidance, and then earnings, you know, show us the bad news. And frankly, we get earnings in about 4 weeks. We get the delivery numbers. When do we get them? We get we get the delivery numbers. I think it's April 2nd. So we're only 3 weeks away from Tesla delivery numbers. You know, so I really feel conflicted. You know, it's kind of like when a stock's falling, you don't want to be like, oh yeah, now it sucks. And then, like, let's say you sell and then the stock skyrockets. Then it's like, okay, well, that sucks. But what's it going to skyrocket on? And so that's where I'm personally conflicted. I'm like, deliveries are going to suck. And I don't see them getting better anytime soon, mostly because they keep ramping up the incentives. So, I don't know. Rumi here says, I work in Fortune 500, and I see a lot of my colleagues will absolutely not buy a Tesla because of Elon's politics. It's not dumping on Elon. He did alienate a lot of Tesla buyers. Right. I mean, unfortunately, I believe it. Tesla has no CEO. He's just promoting his political. And the sad thing is, if the goal is protecting the world from climate change for Elon, then why are you destroying that goal, now deciding that the border is your priority? Like, at least when climate change was your priority, that benefited your company. I don't know. It's just a pisser. It just feels like a knife in the back, you know? Yeah. This is interesting. What is this? Powell used to talk 5-year average CPI, not mentioned in 12 plus months. 5 plus averages, very high. It may take 2 to 3 years to bring back down. I agree. Any comments? Oh, you're right. Well, they got rid of the whole average thing. I think it was last week. Jay Powell killed FATE, flexible average inflation targeting, which, damn, didn't see that coming. Yeah, I really didn't. Like, that was another blind side. I'm just like, God damn, man. Shit. But Jay Powell. Oh, man. To be frank, the ones that he's alienated to need to sort themselves out anyway. I don't know if that's true. Like, I don't think that just because somebody doesn't agree with your politics that, you know, they need to fix themselves or whatever you said. You know, like, I don't think people believe me, but, like, I listen to politics and I'm like, I personally, I've become so resigned to politics that it's the perfect way to be right in the middle, because the only thing I care about are my babies, whether that's my real estate startup, House Hack, bringing content here, or my little baby fintech startup. Those are my priorities, and my little 7 children, and my family. Like, I don't care. And I know people are like, oh, but politics will change your like. Politics has never really changed my life. I can't actually look back and go, oh yeah, everything changed when that person was elected. You know, like, and I'm not saying that politics can't have an impact. Like, sure, politics was all over COVID, right? But then again, that was like bipartisan dicking around. So that's just my way of like disassociating with politics. That's just my take. So, my take. How does that sound like Ross? How does sounding like neutral about politics sound like Ross at all? That's the opposite. Ross is very clear with his political persuasion. I think you're wrong about that one. So, summer surgery is a week from today, by the way. All right. So, all right. Okay. So the question at hand. The question at hand. The time has come. The moment is at hand. The question at hand is, Are we facing regime change where markets expect interest rates to be 4% plus for 18 plus months, and cash flow earnings from compute, AI, consumerism take over instead? That's the question. On QT, Bill Dudley this morning had a piece on QT and argues that with interest rate cuts off the table for now, the U.S. Fed will focus on a different topic at next week's meeting. This is his opinion. When to start QT? I think they did mention that. Bill Dudley, Fed will consider QT discussion in March Fed meeting. Okay. Final plan should be in place by the middle of that last year, or by the middle of this year. Problem is, nobody knows at what level the Fed basically wants to level out on Fed reserves. Right. But that's interesting because the argument here is, could rate, or sorry, rather QT become the priority? Priority or primary tool over rate cuts? Think about that for a moment. If you have rate cuts reduce your ability to respond in a recession, right? Whereas QT slowly stimulates, or stopping QT, right? Stopping QT slowly stimulates while preserving your ability to cut when you need to. That's interesting. That is very interesting. So, Vince here says, Twitter is the best long-term advertisement for Tesla. See, I also disagree with that. I think a lot of people who are on Twitter, they already know what they need to know about Tesla. I mean, how could you not? Everything Tesla gets, like, promoted pretty quickly there. You know, it's like the surefire way to get more likes. So, yeah. Okay. Oh, there are a lot of opinions here about Ross. That's so interesting. I had a surgery yesterday. It cost $6,000. Well, I'm glad you're back to here, and hopefully you're gonna heal well on that. Ask the Chinese during the Cultural Revolution if politics changed their lives. I'm not in China. Come on, Kyle. This isn't freaking China. You know? So, like, it's America. So, anyway. Bitcoin broke 73,000 a little earlier. It was like in the middle of the night. I got an alert. I'm like, what is this? Oh, yeah, it's 1:30 in the morning. And of course, Bitcoin's almost at 74,000. So, very, very interesting. I have questions about assumable loan. Can non-military person take on a VA loan? No. That was an easy one. I at least I'm pretty sure of that. Yeah, I haven't heard that before. Is when you assume a loan, you have to be able to qualify for the loan. Well, you fail the first test when you're a non-military person trying to get a VA loan. Are you a military person? If the answer is no, you don't get the VA guarantee. Because the VA is basically guaranteeing the loan. Yeah. Anyway. So. Alright. I saw that too. The Tate's back in jail, waiting to get potentially extradited to the UK. Yeah, I didn't think that was very interesting. Oh well. As a marketing specialist, I want to hear more about this. As a marketing specialist, X is the worst ROI. What? Between all other platforms and the first cutout in any budget decrease. Really? I'd love to hear more about that. That's actually really interesting. So, yeah, I mean, if you're... So you're in marketing and suggesting basically the advertise. See, that's another risk, right, for Tesla, is that now, I mean, we already know that the debt that Elon Musk has with Twitter is in essentially refinance negotiations. And so what happens when and if Elon needs to sell more stock? Well, it's obvious. Tesla stock go down. So I don't know. Okay. All right. So what else? Let's take a look at some of these sticks here. So NVIDIA, you know, we got rejected at that like 969 level on NVIDIA. We dropped into the 8s, just popped back into the 9s yesterday with a 7% rally. Now we're going down 1% in pre-market. Palantir's been really having a hard time above this 24, 27 level. Just getting rejected a few times over here, but that's okay. It's run quite a bit. Apple is still pretty substantial laggard over here. It did obviously recover since the end of 2022, but boy, in terms of how some of the other companies have really run, whether it's Microsoft or Meta, Apple certainly looks left behind. You've got NIO down 162, Tesla down just over 2. You've got Coinbase down a bit. I'm surprised Coinbase is down a bit with that almost knock on the door of 74,000. A little surprised by that. ASML, yeah, they're a good one. I've got some exposure to that one as well. Look at that. That's crazy. I mean, down a bit too, but they broke 1,000 there for a while. Pretty wild. All right, so, oh, did Coin have an offering? Good call. Let me see. That doesn't surprise me. It's a good idea. And I know the ETF, oh yeah, look at that. $1 billion of convertible senior notes. It actually fell 4% in the after hours. So that actually makes sense. So the fact that it's down, what, 0.5% now or whatever is actually really just offsetting. Like the Bitcoin rally is sort of pulling it up from the offering it made. Okay, 1.6. That's interesting. Yeah, all right. Let's listen in here for a moment. What do we got?
Either divest from Chinese parent company ByteDance or be banned.
TikTok talk.
But while the bill sped through the House, the road ahead is going to get tougher for this piece of legislation. TikTok has ramped up lobbying efforts against the bill, and the CEO, Shouzi Chu, is expected to be in D.C. this week for meetings. Now, dozens of video creators on TikTok met with lawmakers yesterday, and they also held a press conference with a handful of progressive lawmakers who oppose the bill, including Maxwell Frost, who said the roughly 6-month window that TikTok would have to find a new owner under the legislation would not be enough time.
It's unreasonable to believe that in 180 days that a buyer will be found and that the deal can move forward, which would result in TikTok being banned. Whether it's banned for a year or 2 years or 6 months, a ban is a ban.
The bill also lacks a clear path in the Senate right now. I spoke with senators yesterday, and they told me that they share the national security concerns that the House has, but they've got some other issues that they're worried about. These include things like freedom of speech, whether the bill singles out and punishes TikTok in an unconstitutional way, and the ramifications of getting rid of a popular app among 170 million American users. Congressman Mike Gallagher, who chairs the House Select Committee on the Chinese Communist Party and is one of the bill's main backers, has said that this bill has been tailored to avoid past pitfalls to other bans on TikTok, such as measures that are too targeted against a single company.
What our bill is a regulatory framework. It is prospective for companies that are controlled by a foreign adversary. It's a regulatory framework, not a punitive framework, and therefore I think any concerns over a bill of attainder simply don't obtain in this case.
All right, this is a little boring. It's kind of entertaining seeing this because on Monday Donald Trump was super anti Facebook and kind of whacked the stock a good 4%. Everybody on Wall Street is like, damn, he still got it. Always kind of interesting. Yeah, this idea of forcing TikTok to sell, to different ownership is going to create some substantial legal battles. The problem is when you have a congressional law. I mean, you could check the power of Congress, but boy, when Congress decides to do something, it's tough when something's written in law to fight the actual underlying law. It's one thing to go to court. It's another thing to have a law written against you and then try to fight that. I don't know. Somebody here says Elon should buy the talk. I don't think Elon can afford the talk anymore. Oh, and I'm just kidding. I expect obviously he could. I mean, what's ByteDance? Let's see. ByteDance. Let's see. ByteDance, what's their value? So the value of the company, wow, revenue is $85.2 billion. So it's the value of this company. ByteDance, let's see here. Oh, yep, he might not be able to afford it. It's valued at around $268 billion. Wow. Yep, can't buy TikTok. So that's interesting. I mean, I guess the idea, I mean, you don't have to buy all of ByteDance to get TikTok, but I think TikTok is probably the biggest source of revenue within ByteDance. So you do end up making a very expensive company. And that's going to be a hard mountain for companies to bridge basically. So what do we got here? Let's see here. Markets are able to ignore the inflation elephant in the room. Let's see here. Inflation is becoming the guest at the dinner party who just won't leave. Tuesday's data shows that it's getting at least one more drink and may yet try to stay the night. The market's attitude, however, is becoming one of avoidance. If you ignore inflation, hopefully it'll just go away. Certainly the early reluctance after data, blah, blah, blah. Underneath the surface, US CPI is becoming embedded. The chart below, I'll put this up in a sec. Chart below shows structural CPI, defined as the index components which are persistently above their long-term average, and cyclical CPI, which are the components not counted as structural. Most of the fall in headline CPI has been driven by cyclical, while the fall in structural has stalled. Ah, great. Yeah, that's not good. And I think, we're reading earnings calls all of the time, and we're seeing companies cut prices. I mean, even Costco, that's just like the definition of Costco, though. It's like racing to cut prices. But the problem is, you don't necessarily get all the earnings calls for companies like how do you put it? Health insurance companies, hospitals, medical care service providers, dentists, your financial advisory firms, basically all of the things that go into services CPI. So you get a lot of the cyclicals, frankly, and that's a problem. So let's write that down. So that's cyclical versus structural inflation. And I want you to see this chart. So we're going to pull this up together. Uno momento. I don't know Spanish. I'm not even going to pretend. Okay. So let's see here. ehack.com. I like ehack. Okay. So this is the chart. And what you really have to do is look right here, and you kind of see structural getting stuck. So structural getting stuck is likely, like I said, your personal services is likely personal services, insurances, pets, to some extent things like car rentals. And a very slow decline in rent inflation. Again, keep in mind, only Like, when rents go down, this is a big problem. Only about 3% of households move each year. So your realization of lower rents is very slow. Whereas the realization of higher rents can be way faster because you don't have to move to get higher rents. But you generally don't see your rent go down, like, if you stay. Realizations of lower rent is very slow because you usually have to move to get your rent lower. But if rents go up, it's much easier to get your rent increase. That's a very interesting thing that could actually be leading to this sticky structural. That's a real estate, phenomenon, I dare you call it. But that's a problem. Cyclical would be more like your consumer goods. When I think of cyclical, think of what gets hurt in a recession. So manufacturing, durable goods, like washing machines, like appliances, I'll just say, etc. So cyclical's probably going to be a lot more interest rate sensitive. Cyclical likely more rate sensitive. Hence the price drop. So like interest rates have killed cyclicals. I mean, like, you could basically just put Tesla on that line and be like, oh yeah, interest rates did great at killing Tesla. But did they really solve all of the inflation? Nope, not at all. Oops. Damn it, Jerome Powell. I didn't know you had a hate on for Elon.
Hitting almost every day, one from either side in terms of arguing their case. Obviously, Trian's argument, hey, the performance of the stock price has not been good over a long period of time. We need to be on this board to ensure that, in fact, shareholders are looked after. Disney, for its part, spending a lot of time with its own shareholders. In fact, I know Bob Iger, Boston, Baltimore, Washington, D.C., you name it, sort of visiting with various shareholders, because, again, this is sort of the heat of the moment right now in terms of both sides making their arguments, large shareholder bases being the key. So the institutions that control many of those shares, as you might expect, are getting their chance to hear from Mr. Iger, for example.
Disney! Okay, so what else? Well, yeah. What a crazy market. I mean, see, what's crazy is my thesis has always been that we'll have a Nike swoosh recovery. And I actually think that swoosh will keep going for quite a while. And that was based on people getting more comfortable with inflation. But the idea of people becoming more comfortable with inflation was that inflation would consistently come down. That there wouldn't be this, Weimar Republic style inflation. Well, that's happened so far. The volatile Nike swoosh, so to speak. That's played out. But now with inflation stalling, people are also becoming more comfortable with inflation just potentially staying higher, which means rates are higher, which might explain why there's such a movement in stocks to stocks that potentially just straight up benefit from higher rates. I think the AI stocks and the mega caps, the Microsofts and the Metas and stuff, I think they benefit off higher rates. And the yield on their cash is just crazy right now. So they could just use the yield alone. I mean, if you had $20 billion of cash sitting around and you were earning 5% on that, that's like earning $500 million in interest doing nothing. It's crazy. Oh, I did the math wrong. That'd be like earning $1 billion, right? 20 billion in cash, 5%. It'd be like earning $1 billion doing nothing. That's a lot of money for NVIDIA chips. So, kind of crazy. Okay, let's go take a peek at what some of the other things suits are saying. Okay, so let's see here. Morgan Stanley or can I get that? That'd be interesting. No, that's not there yet. No. It'd be nice to... oh, here's a TS Lombard. Okay, yeah, let's see what they're saying. They usually are bears. Okay. Foreign safety for cost of the... okay. What do we have here? Quit rate brings labor market back into better balance, but it won't mean much for wages. Upward track for real wages. So an upward track for real wages puts more potential pressure on inflation. Household liquidity remains high. So too real spending on things people want. I want to see what they're saying with wages here. Better balance in demand for labor. No real softening. Quit rate down. Layoff and discharge rate flat. So that hasn't changed at all. As firms need to pull labor from self-employment, real wages rise. Well, real wages could be rising because inflation, at least the rate of inflation, is coming down. But, But that is still also supported. I mean, it's a ratio, so it's still supported by some level of wage payments continuing to be made. This is not the 1990s when firms borrowed to boost productivity. That's also fair. That's an interesting comparison. The 1990s, sort of debt bubble. But let's look at real wages for a moment. So if I go St. Louis, let's do that. Real wages. I mean, we have it right there. But I want to see if... is that roughly the same thing we're getting? I mean, yeah, it kind of is. It's roughly the same thing. So, just, this one zoomed in to about 92. So, really measuring from about here on. So, they kind of measured from the bottom on this one. But, shows you that year-over-year change in COVID was so negative. That's the Atlanta Fed on this one. There we go. Well, that's... I see what they're saying. They're basically arguing... Well, here, let's see. I've generally found that the payroll survey employment rising relative to the household sector is most often a signal of tightening demand for labor, the need of firms to pull workers from self-employment. A pure sign of an impending recession is payrolls data dropping relative to the household's number. Real wage growth does, in fact, track with this ratio. For all the hard ringing about wage growth and shifts in labor power, it is notable that real wage growth has to run as high as it did pre-COVID. On a percentage basis, what they're doing is basically comparing it to pre-COVID. So it's really a way of arguing that you actually really don't have a looser labor market yet. You're still having to continue to pay more to get workers. And that's an interesting idea, this idea of like robbing workers from self-employment. Because if you... let's think about that. So let's logic this. What is the household survey? Well, the household survey is, hey, do you have a job? Payrolls is calling companies, do you have workers? Okay, so... household survey, payroll data, count. So it must count self-employment. Let's see here. Self-employment. Ooh, the unincorporated self-employed. The household survey is designed to measure the labor force of the civilian non-institutional population. The National Employment Reservation for household survey, employed people, agricultural workers, and self-employed. Okay. So it does, the household survey includes self-employed. But the payrolls data wouldn't. Oh, that's interesting. See, that's an argument I haven't heard before. Okay, so think about that for a moment. Let me do this. There we go. We've consistently now seen payrolls data hot, households weak. Okay. what happens if people are taken out of self-employment because rates are high, small biz is tough, and people go get a job, so to speak. Okay, well, household would show negative loss. Wait, no, household wouldn't show growth, right? Household, so one worker goes from counted on household and not counted on payroll, self-employed, right? To counted on payroll and counted on household. So they'd be counted on both. So that wouldn't necessarily show a decline on household, but it does increase the payrolls. So really what it would do is if you're robbing from self-employment, you're boosting the payrolls numbers, but not necessarily the household survey. And then obviously whatever kind of worker loss you have in the household, it would lead to the negative. So that is very interesting. Self-employment potentially leading to these hotter numbers. Ripping people out of something I haven't thought of before. Very interesting. This is why I like reading every day, because it's amazing just how much different perspective and how many differences there are in explanations for what's possibly going on out there. That is one that is new. So, all right. What's next? Well, we got 3 minutes to the bell. I don't think we got data coming. When's data coming out? Tomorrow. Tomorrow we get retail sales and PPI. Oh, that'll be fun. Yesterday, growth stomped value. The pre-market winners in the S&P 500 today, though, are healthcare, materials, and energy. Infotech is set to undo some of the outperformance from Tuesday. That suggests yesterday's price action might be a blip, and the rotation out of growth names into value might be set to continue. Ooh, value, materials, energy, real estate. Getting out of the names that have ran so far, really? Let's see. Let's see how we see things pre-market here. So we've got, hey, Petco Health and Wellness, talking about health. Mind Medicine. These are at your top right now. Carnival Cruise Lines up 1%. And there's Microsoft, because isn't 420 their resistance? Now, I don't think the question is, do you trim Tesla because of the lack of near-term catalysts? I don't think the lack of near-term catalysts is the problem. I think the problem is negative growth. You know, that is a catalyst. So the near-term catalyst, like, there is no lack of near-term catalyst. There is a near-term catalyst. It's delivery figures. April 2nd. That could be a disaster. And it's not just that, but the forecast. I don't think this is true. GMP here says EVs are a fad and will disappear. That I don't think is true. I do think the future consists of an electric vehicle future. There's no doubt about that in my mind. Obviously, I could be wrong, but that's just my opinion. And I think for me, that's driven by the fact that battery technology will solve the cold weather issue that is one of the few complaints that folks have. And then, of course, charging infrastructure is already rapidly expanding.
It is Ellevest, an investing and wealth management company for women, built by women.
Tesla's going to get wiped out by Chinese cars. That's more likely.
In about an hour. And at the NASDAQ, it's Deal Makers, a community of female C-suite leaders and investors in the retail and consumer spaces. Speaking of which, Mike, got a lot of retail news out of Williams-Sonoma and Dollar Tree and Petco, too.
We did. Dollar Tree is, a little bit of a messy set of guidance, I guess, is the way the street is taking it anyway. Going to be closing a ton of Family Dollar stores. Remember, that was the merger. Stock opening up down 11.5%. Even leading into the number, there was some questions around, the pacing of tax refunds. And
let me see that. That's Petco. Petco just reported earnings. Their net sales came in at 1.7 billion versus 1.63. That was Petco, at least. Comp sales, actually, they're doing better than expected here. However, their loss in the first quarter is expected to be worse. CEO transition surprises amid recent mishaps. All right, so there's some shenanigans going on over there. And then Williams-Sonoma this morning. Let me see here. Williams-Sonoma, they gained 4.5% after results and buyback. Q4 comp sales were negative 6.8% versus the 9% expected. See, that's the other way you could gain, is like estimates could just be so bad that you end up so you have really bad estimates, and then you beat those bad estimates. But the problem is a lot of the interest rate sensitive stocks, they have bad estimates, and then the reality is even worse. It just sucks. I laugh not because it's funny, it's painful. Anyway, so where were we? Let's see here. This is vague, but my friend works in the automotive industry and talks a lot about hydrogen hybrid vehicles instead of electric ones because the grid cannot sustain millions of vehicles. Yeah, I disagree with that. I actually think the grid has gotten substantially more resilient, thanks in part due to solar. You've really moved your peak energy generation times. So I'm not convinced by that. But that doesn't mean I'm gonna be right. You know, I've come to respect other people's opinions. So Tesla and Enphase right now, Tesla and Nvidia right now actually competing for the loser position of the day. Now Tesla's gaining. People buying the dip on Tesla. It's only down 1.6 after that Wells Fargo piece. Nvidia down about 1.9, AMD down about 2.6. I mean, that's just like a give back from yesterday. That's not a surprise. And then what do we got? What do we have at the other side? John Deere's up 84 basis points. How's Williams-Sonoma? Let's look them up. WSM is Williams-Sonoma. 10%. Holy smokes. Wow, look at that. Williams-Sonoma all-time highs. This is the week chart right here. My goodness. So let's take a peek at what else we have here. So that the consumer spending drought that was supposed to be really never came. I don't know if it's just backed by people borrowing more, probably. But even Stripe, for example, Stripe's like they processed over $1 trillion in 2023. That was like 25% higher than what they did the year before. That's just wild. Really impressive. Obviously, we heard yesterday Trump won the nomination. That was not surprising. I didn't even really feel like news. I saw that notification pop through, and I'm like, yeah? All right. I thought that was already decided Super Tuesday. I mean, I know it wasn't officially decided Super Tuesday, but I felt like that was all you needed to know. Coinbase just went positive. AMD trying to knock on the door here of 3% down. There it is. Now it's at 3% down. And Tesla's actually recovering pretty well after that brutal Wells Fargo piece. Somebody here in the comments shouted out this Market Watch piece. Let's see. Key momentum indicator has been trending higher for the last couple of months. Let me see here. Really? This was posted March 12th, so it was posted yesterday. Tesla bears beware. The electric vehicle giant stock has bounced sharply off a 12-month low at a time. Charts have been warning that momentum may have already bottomed. The chart indicates Tesla is firmly in the longer-term downtrend. It has been flashing a bullish technical divergence that suggests shorter-term tide may be changing. Now could be safer to buy the next dip. Bullish divergence refers to when a stock continues to hit lower prices, even though the underlying momentum indicator trends higher. Yes, fair. Hit a 13-month low on the RSI. So basically, they're trying to say the RSI popped a little bit. January 25th was their low. That was over here, was their low. So you've seen the RSI trend higher. But then again, the stock was actually going up. Now the stock's back to going down, and the RSI is going down again. So haven't been on lower sold since Feb 6. I mean, this is just one indicator. So somebody reading the RSI over here. I mean, if you look at the week chart, that RSI is not trending up, bro. Okay, if I just zoom out to the week chart, the downtrend is very blunt. The RSI is right here. I have it too. And that is a blunt downtrend. And if I go to the week chart, or sorry, the day chart, I also see a blunt downtrend. So I don't know if this guy like wrote this article like 2 weeks ago and it took them 2 weeks to approve it. But that is not a divergence in my opinion. Whatever. Whatevs. Okay. What else? I don't know. What do they got?
We've seen that at some of the rental fleets, disgruntled customers, and
What?
the possible loss of the brand premium 120.
Oh, this is the Wells Fargo article. We were talking about this.
And they were at 200. It's not quite as draconian as the Deutsche downgrade earlier in the week, where they went to 218.
Yeah.
But yeah, that's a bearish view. It's even below Bernstein, which has been at 150 forever.
Exactly. I mean, the radically cut earnings estimates in the Wells Fargo downgrade, they're looking for $2 this year. The consensus is $3.03. They're
Wow, that would be a huge crush. $2 in EPS. Oh, that'd be so bad.
So obviously, the call here is that the street is asleep in terms of the longer term dynamics. And just for benchmarking sake, the company earned $4 in 2022. So in terms of that sort of static profitability at best, and now it looks like, if Wells is right, the slide.
Well, it wasn't exactly $4. Adjusted EPS was $3.66. But yeah, the forecast right now is $3.03 for 2024. That has not moved at all over the last like 2 or 3 months, and delivery estimates keep coming down for Tesla. So that's a little weird. And so, now that's why I think you're starting to get some of these pieces coming out, because people are maybe waking up a little bit. But let's listen in a little more.
Restructured portfolios, better collaboration, 10% upside, he says, to our targets across the U.S. auto space.
Yeah, interestingly, 10% upside, 7 if you exclude Tesla. So he still loves Tesla. He still has this, big integrated bullish call on Tesla in terms of the price target. But it seems like he's sort of articulating the GM story of recent months.
Right, where there have been some really interesting executive moves in the past 24 hours.
Yeah.
One was that Mike Abbott, the former Apple executive who joined to be their software czar, is leaving. And then they hire this former Tesla executive to be the new head of manufacturing at GM.
And just the idea of we're just going to throttle back on battery vehicles to some degree and share some cash with shareholders, as of course GM has done. So stock has had a decent run. So it is interesting, and you would.
Yeah, I'm not arguing that RSI divergence isn't a powerful indicator. I'm just arguing that there is no RSI divergence. I disagree that it exists in this particular stock. So anyway, more on Elon.
When they can actually resume production. The other story I would add, guys, is this piece out of the South China Morning Post about BYD pricing their new compact SUV at the equivalent of $12,000 US. $12,500 for a compact electric SUV.
Amazing.
Wow.
Which has
It's
implications.
almost like a disposable car.
Exactly.
Yeah. Like so many things from China. They'll send us clothes. You can put them, for a year or two. All right, I'll get a new one.
Like fast fashion for the car.
I was going to say, this next model that Tesla is looking to come out with is kind of a compact SUV.
The Model 2.
The Model 2. Yeah. So it's tough to be profitable as it is.
And that's why we're going to talk to Dan Ives next hour about why he still thinks this negative sentiment on Tesla's overdone, sees $1 trillion valuation still possible as these new models, lower cost models, roll in.
Yeah, it'd be interesting to hear. But Dan Ives, he's a long-term Tesla bull. And I actually like the guy. I think he's got some pretty good ideas. But sometimes I wonder, is there a risk of having this emotional attachment to a stock? His quote is, "We believe the stock is way overshooting on the negative front as the demand story is more in stabilization mode." See, I don't know if that's true that it's in stabilization mode. If you get negative year-over-year numbers, that's not really stabilization mode. That's not growth. But okay, maybe that's too short-term minded. He does say in the near term it's not roses and rainbows with demand sluggish for Q1, Berlin Austin arson shutdown, and noise around Musk's comp plan. That said, we believe the risk reward is extremely compelling at these levels. That's Dan Ives. I think that's a good argument. Like, at least somebody's making a defensive argument. Let's see here. Yeah, he's not on until like 6:30 though. You know, and then there's this idea that, oh, well, maybe the board will take over and solve these issues. Like, actually fix some of the comp plan issues or provide some direction. But I don't know that that's likely to happen. Yeah, and then Gary Black on Wells Fargo suggests when a Wall Street analyst downgrades a stock to sell, it's more often than not a reflection that near-term expectations are too high rather than a long-term view that the valuation is too rich. So basically trying to water down a little bit of that Wells Fargo piece, just saying like, hey, the near-term is going to suck. I kind of agree with that. I think the long-term price targets from the analysts are a little loony often.
Aggressive, hostile offer. There was concern that had been raised numerous times by Wyndham about the antitrust effects. But I would note an interesting choice here by the FTC yesterday that I can rarely remember seeing in the past. They didn't comment on the potential antitrust ramifications of this deal while Choice was trying to buy Wyndham. But they chose to come out yesterday and say, hey, you know what? We were taking a close look at this thing. And just so you know, we thought it would have been a really serious competition question that would have been raised. And so the fact that they decided to not pursue it is a win for consumers. I thought that was odd, given there was no reason to weigh in whatsoever. They had not done so during the course of Choice's attempts to acquire.
Let's pull this off. There's also this talk about Dollar Tree. Dollar Tree closing 1,000 stores. That's interesting. The stock's down 13%. There we go. Look at that. 13%. The Dollar Tree. Zoom out for a moment. And, well, boy, that downtrend looks freaking familiar. I've seen a downtrend like this before. And, it's at this stock that rhymes with Esla. That's not good. So, something like that. It's not great. Could probably do better than that, but good enough. Not trading the Dollar Tree anyway. But it actually might be better than I think it is. Pretty solid. Almost bouncing off the 200-day moving average there. Fascinating. Nvidia, pretty volatile. Look at that, down 2.5% right now. And then you've got, what else going on? Tesla down 2.2. Enphase down 0.64. New York Community Bank sitting at 3.5. Let's go. The biggest losers today. Wow, AMD down 4%. And Supermicro Computer only 1.8. I mean, this is nominal. Intel is only down 1.0 basically on their loss of Pentagon contract. The rally mode is Williams-Sonoma today. Celsius up again. This one just keeps going. You know, this is another one. It just keeps going and going and going. Look at the day chart of this. I mean, the amount of green you've had over here is just enviable. Enviable green. Lots and lots of green. It's always the stocks that you're not in, right? Someone's like, I'm mad I sold my Celsius. I know, that's the tough thing. It's, you know, you look at the... It's like if you sell and the stock goes up, you're pissed. And if you don't sell and the stock keeps going down, you're pissed. And then when other people's stocks go up and yours don't, you're pissed. So the stock market is really just a place for you to just always be pissed. I mean, I guess you could cheer, like, if you're all in on NVIDIA, you know, you're probably very happy. But, you know, good for you. So everybody gets their win time, so to speak. Dollar Tree is 8,200 stores closing, so 1,000 is just 1/8. Oh, maybe they close more. Wow. Didn't know they were closing that many. It says here, plans to shutter about 1,000 stores. 600 in the first half of 2024, and another 370 to 400 in the second half. They do operate about 16,700 stores. They're calling it a prudent decision. Right. Yes. That's a great way to have negative revenues, is when you start closing stores. All right. Somebody else here says Embraer has been on a tear lately. Let me see. Yeah, they've done pretty decently. Nice little breakout over here. I like Embraer. And then Apple starting to have a downtrend like Tesla. Yeah, AAPL. But it makes you wonder, like, do you buy Apple here? You know, if like Apple at 172, what are the financials on it? Let's look at it really quick. AAPL. Financial analysis. So $6.61. So you're trading for like what, 30 times? Oops. Let's see here. 173 divided by 6.61 expected for September. Wow, that's only trading for 26.1 times. Well, then it's going to come down to the growth rate, though. So growth is expected to be 8.93, 8.44, 12.91, 22.25. I don't see how they're getting that. Coming out of the hole, maybe. Okay. Divide that by 4. 13. 2-peg. It's a 2-pegger. Apple at a 2-pegger. See, it's hard to run a peg on Tesla if the EPS projections keep moving down. That's, I guess, the problem. But what are you going to do? So, all right, let's see if I can get another comment out of the suits here. So, let's see here. BofA. Retail shrinking wallet. Ooh. Tomorrow's retail sales report. We expect a 0.1% drop in ex-autos. Ongoing weakness in nominal retail spending is partly for good reason. Broad-based deflation in goods. However, another reason seems to be that strong services inflation is weighing on retail's wallet share. Ooh. Retail spending less because there's too much inflation. Interesting comment there from Bank of America. Let's look at another one here. No, that's boring. Boring. City? Okay, what is this? this is on US CPI. Oh, this is just sort of recapping what happened. That's boring. All right, what are bonds doing today, by the way? Let's see. Bonds today are up 4.176 again. Wow. And then gold's still knocking on the door of 2,200. Oil 83.5. TikTok votes at 10 a.m. Cover it afterwards. I don't want to sit there, watch it. Musk visits German Tesla Gigafactory after arson attack. Oh, yeah. Went to Berlin. All right. Kevin, hear me out. Oh, Yeti. You're starting to say what I was thinking about yesterday. Stop saying it out loud. You're giving it away. Kevin, hear me out. iPhone with integrated AI. At the moment, most people don't use AI in their everyday life. Imagine AI from the perspective of Apple. 100%. I think Apple... Well, I'll keep some of my thoughts to myself. Okay, no, I won't. I think Apple could be the actual, like, one of the actual biggest consumer-driven AI plays that actually makes money. And they just build it into, you know, the Apple ecosystem, raise the price for it. They're behind right now, but they always are. They always are. And but when they do it, you know, they do things pretty well. Yeah, I was using. There's a balance, but I really like how these suckers get me to zone into doing something like really boring. Oh, I got to go to the course member live. But yeah, I was using this quite a bit yesterday, and did not mind that. All right, so I guess it's time to go. Let's do another check of the markets really quick, and then we'll go. And let's see. Nvidia down 3%. Dollar Tree falling more. The chip's just giving back a little bit from yesterday. That's fine. Tesla's only down 158. People not really caring anymore about the bad news. So, like, the amount of selling pressure here surprisingly seems relatively limited. This is what we saw yesterday, too. It started out with some selling pressure and basically ended up the day nearly flat. It's pretty impressive. No, anyway. All right. Now I'm going to push the button. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Hey, remember, folks, if you have not yet checked out the June 21st to 23rd Finance Innovation Real Estate event, it's going to be really exciting. You're going to learn a lot about real estate. You're going to learn a lot about getting started in real estate, making money in real estate, and otherwise. There'll be some other fun topics as well, but it'll be really good. And once we announce the venue, we will be popping prices a little bit. So, again, do check that out. Go to meetkevin.com, and we'll see y'all soon. By the way, we're getting a ton of emails also of people who want a 1031 into HouseHack Properties. If you have not yet heard about that, we have a little handout. You could email us at ir@househack.com. Just let us know what your situation is, what you're thinking about 1031ing, proceeds you're looking at, and we can get you some more intel. Thanks, folks. Bye.